Hey, welcome back. Thank you so much for joining me in today's video. I have an update for you guys regarding some leading indications of our U.S. housing market regarding credit availability, mortgage application numbers, pending home sales, and of course, much more. These are some indications about which direction our housing market is headed. And I'll give you my opinion regarding what I'm thinking this data means for real estate in the US. Let's first talk about this new report from the MBA, or the Mortgage Bankers Association, just posted yesterday on April 9th. This is a look at credit availability. An easy way to look at this is that when credit availability actually increases, this means it's easier to get a loan approved. When credit availability decreases, it means that lending standards are more tight, so therefore it's more challenging to get a loan approved. So for the month of March, credit availability, or mortgage credit availability, increased by 1.1%. This means that credit is actually getting a little bit looser. In other words, easier to get a loan approved. However, according to Joel Kahn, who's the MBA's vice president and deputy chief economist, he stated the following: although credit supply increased for the third consecutive month, in other words, lending standards getting more loose, it remains low at nearly 7% below a year ago and still close to 2012's lows. So here's a look at a chart looking at their index. In other words, a huge increase of their index means that lending standards are very loose. And we saw that in 2017-18, at least compared to the past decade. So here's current lending standards right now, far below what we saw looking at pre-COVID levels. Also, the current level we have right now, more or less in line with 2012. Now, here is a snapshot looking at this index going back to the year 2004, which is kind of laughable because we did see this small increase by 1% from February. But when you look at the chart here, I mean, it's just laughable because looking at pre-COVID levels, again, the highest levels since approximately 2012, but look at 2004 through 2007. The index was approaching 900. Now it's only at 93.9. In other words, right before the Great Recession, it was very easy to get a loan approved, as you can see there. Whereas right now, lending standards are actually more tight, or actually a lot more tight, which is more healthy for a housing market. And of course, one of the reasons why our housing market crashed in 2008 was because of this right here. A lot of people who got loans approved to buy houses, they bought houses and they couldn't even afford the payments. So if you basically could breathe into a mirror and you would see fog in the mirror, you get a loan approved in 2004 and 2005. Whereas right now, much different. In my opinion, healthy for a housing market in the long term. Here's yet another report from the MBA just posted today, which is April 10th. It says applications for home loans increased by 0.1% from 1 week ago. This covers the week ended April 5th. So the MBA breaks it down by people who are submitting loan applications to refinance and also people who are submitting loan apps to purchase houses. So the refinance index increased by 10% compared to the previous week. Alarming, right? However, this number here is not seasonally adjusted. So keep in mind, this covers the week ended April 5th. The previous week was when a lot of people were on spring break and we had the Easter holiday. So of course, there wasn't a lot of people who submitted loan applications to refi during spring break or during the holidays. So the reason why this index increased compared to the previous week was because that this week was just after spring break. And again, it's not seasonally adjusted. In contrast, here's a look at the seasonally adjusted purchase index that decreased by 5% from 1 week ago, and it's down a whopping 23% from 12 months ago. So we have a low level of the amount of people who are submitting loan applications to buy houses right now, which implies we could see low levels of closed home sales in the weeks and months ahead. And Joel Kahn stated the following. Rates moved higher last week as several Federal Reserve officials reiterated a patient posture on rate cuts. On top of that, we had the CPI report that was announced today, which showed that inflation rose faster than what was expected, and rates just got absolutely clobbered on Wednesday. Inflation remains stubbornly high and also above the Fed's target, and the broader economy continues to show resiliency. Unexpectedly, strong employment data released last week further added to the upper pressure on mortgage rates. Meanwhile, still about 33.3% of all applications were for people doing a refi. And that number seems very high, but that number has been around 30% for quite some time. On top of that, the adjustable rate mortgage share or ARM share of activity was around 6.9% of total applications. That hasn't really fluctuated very much. I believe the 24-month high was around 12% and the low was around 3%. I also found this for you guys as well. This is on ResiClub.com, a really good website if you guys want to read a lot of analytics regarding our U.S. housing market. Anyways, they shared this because this goes back to the early 1990s. This is the share of ARMs for applications according to the MBA. So right now we are around 7%, more or less in line with pre-COVID levels. But look at 2004 and 2005. The ARM share of activity was around 35%. Now it's only 7%. So go figure why our housing market tanked in 2008, because of course a lot of people were getting loans they could not afford, and also they're getting ARMs as well. I also found this for you guys as well. Here's the MBA's purchase index over the past 5 years, and this is on investing.com. And this really tells me how we have a low level of activity for people who are applying for home loans, therefore implying that close home sales will remain very low as well. So here's a look at their index over the past 5 years. We're sitting right now at 138.7 is our index, which has been going down ever since really 2022. And also it's much lower compared to the pre-pandemic average at around 250 to around 280. And again, right now we're sitting at around just under 140. So a low level of applications right now. On top of that, even though refis increased a whopping 10% from 1 week ago, current levels are extremely low, which is right here. You can see how low these numbers are. The index right now at 498. Look at the peak back in, this is absolutely crazy. Back in March of 2020, it was at 6,418. Now it's less than 500. Refis basically falling off the map ever since really 2022. All right, let's change gears slightly here and talk about the amount of people who are going onto Google searching for homes for sale. So the index right now is at 69. 1 year ago, we were at 91. This means there's approximately 24% less interest for Google searches for homes for sale compared to 12 months ago. Also, here's a look at real estate showings across North America. That increased by 33.1% from the start of this year compared to the first week this year. Last year, this time, we're up by 8.7%. On top of that, we're seeing more sellers having to reduce their asking prices because the share of price drops, according to AltosResearch.com, is at least a 5-year high. That's because the share of price drops at 32% is higher compared to last year at this time at around 30%. Also much higher compared to 22, 21, 20, as well as 2019, when at that time the share of price drops was at 29%. Now again, it's around 32%. Also, we're seeing inventory also increase as well. So right now there's approximately 512,000 homes for sale, according to Altos Research. This is approximately 100,000 more compared to 12 months ago. Also, it's higher compared to 2022, 21, but lower than 2020 as well as 2019. Again, keep in mind, home prices decreased by around 13% at the peak of the decline, according to my own analysis of NARS data back in 2022. But inventory levels were still far below pre-pandemic levels. The reason why prices decreased so much in 2022 was due to the sharp increase. In other words, due to the rate of increase, not due to the level of inventory. So for example, the lowest was more or less in March at around 247,000 houses for sale. But by the time we hit August, we were at 544,000. So inventory levels more or less doubling in that time frame. Therefore, what I'll be closely following and reporting on my YouTube channel here is the rate of increases or decreases of inventory for the remainder of the year, because that'll be very much a determination about which direction our housing market is headed. In regards to that, I want to share pending home sales, a measure of contracts being signed between buyers and sellers of existing houses, according to Redfin, because that is at least a 3-year low as well during the same time frame. For the 4 weeks ended March 31st this year, pending sales down by 2.8% year over year. So I'd love to hear from you guys regarding this report I'm sharing in today's video. In my opinion, all these factors here, all these reports is pointing to an environment that we have interest rates higher for longer, which is going to impact sales this year. And so I'm just really curious where we'll end up the year, because last year we ended the year at the lowest level since 1995 regarding existing home sales. So if we have this environment in which rates are above 7% for an extended period of time, that's really going to impact sales and should increase inventory levels as more home buyers get priced out or they decide to hold off on buying a house. Of course, time will tell, and I'll definitely keep you updated on the channel. So make sure you're subscribed. I appreciate you guys watching today's video. Like and subscribe. Of course, share this video with anyone you want on social media. Hope you guys have an awesome day and look forward to seeing you on the next video.